Matt Santiapada, Santa knows best.
Andrew Young, Mortgage Wise Financial, and the Community Mortgage Movement.
Andrew, thanks for coming, and today we are going to talk the difference between fixed versus variable. So Andrew, what is the difference between a variable mortgage and a fixed rate mortgage?
As I go through with every single client, I love going over these options. So fixed, very easy to explain. So you have a term, 1, 2, 3, 4, 5-year terms generally. Some lenders offer 7, some lenders offer a 10-year fixed term. So you know what your payment's going to be, you know what your rate's going to be for whatever that term you set up. With variable rate, there's a couple moving pieces with it. Number one, the prime rate, or the prime bank lending rate, as they call it, is one portion, and that's the portion that can move and can increase and can decrease depending on what the banks are doing or what the government sets in and they want to make some changes. The fixed portion of the variable rate is your discount off of prime or premium on top of prime. When I say premium on top of prime, I'm more referring to a homeowner line of credit, where that's going to be prime plus generally 0.5, something around that area. With the regular mortgages, you're going to look at a prime minus. So anywhere between, right now in the current rate environment, prime minus 0.25 to prime minus 1% in some circumstances.
When it comes to a fixed rate mortgage, how is the rate determined?
So banks and or the lender buy pockets of money, and then they have to make money off that money. So that's how the interest rates are created. So they have to make a spread on the money that they've purchased from big conglomerates, other banks, pooled funds. So that's how the fixed rates are created.
All right, Andrew, so when it comes to a fixed rate mortgage or variable rate mortgages, how do the penalties, differ between the two?
Sure. With most fixed rate mortgages, and I'm just going to speak generally because every single lender is different the way that they calculate penalties, okay? So first and foremost, with the fixed rate, you're either going to run into a 3-month interest penalty or you're going to run into something called an interest rate differential. That's the one you really want to avoid. There's also some low rate basic mortgages that could charge you a certain percentage. So 3% of the pound or of the current balance if you were to break your mortgage.
Really?
So you need to be really sensitive about what sort of penalties, and my job isn't just to get you into a mortgage, it's to make sure you understand what it takes if you need to get out of the mortgage.
Makes sense. 3% can be pretty hefty.
3% can be a big penalty. That's a lot of hamburgers.
Yeah.
So on the other side, variable rate, with most lenders, it's a 3-month interest penalty. So with the fixed rates, there's a little bit of a variance there because it could be 3-month, which is good, or an interest rate differential, which is bad, not good. And with the variable rate mortgage, you're looking at a 3-month interest penalty for most lenders. And there's also that low rate basic where you can get into a 3% penalty with the variable rate as well. So bottom line is, know what you signed up for.
So if you're looking to break your mortgage, you better do your homework.
Absolutely,
beforehand, because otherwise, we're talking thousands there.
It could be tens of thousands.
Yeah, it could be some pretty serious cash. Wow. Yeah. So know your stuff. It's Matt Santiapada, Santa knows best.
Andrew Young from Mortgage Wise Financial, Community Mortgage Movement. Fixed versus variable.
Me.